our studios in New York, Bill Moyers.
Welcome to the Journal. Every week we hear of another publicly traded company being bought by a private equity firm. Some of those investment firms, like Blackstone, the Carlyle Group, and Cerberus, have become almost as well known as the brand name companies they've been snapping up, from Chrysler to Dunkin' Donuts to Toys R Us. But private equity firms have no real interest in toys, cars, or baked goods. What they're after is big and quick returns on their capital. To get it, they buy a company and cut the wages, pensions, and health benefits of the employees who work there. Take a look at this front page story in Sunday's New York Times for a glimpse of how this kind of capitalism works. Thousands of nursing homes have been bought up by private equity firms like Warburg Pincus and Carlyle. Profits were increased by reducing costs. Then investors quickly resold the facilities for a big profit, leaving, and I quote, residents at those nursing homes worse off on average than they were under previous owners. Exhibit number 1, Habana Healthcare Center in Tampa, Florida, purchased by a group of private equity firms in 2002. Quote, within months, the number of clinical registered nurses at the home was half of what it had been a year earlier. Budgets for nursing supplies, resident activities, and other services also fell. When regulators visited, they found malfunctioning fire doors, unhygienic kitchens, and a resident using a leg brace that was broken. Basing its report on government data, the Times says 15 at Habana died from what their families contend was negligent care. But when families sue, they often can't find out even who owns the nursing homes because of the complex corporate structures private equity firms have created to cover their tracks. It's this kind of capitalism that drives John Bogel up the wall, as you're about to learn. John Bogel believes owners should be in charge and accountable. He's known and respected worldwide as the father of index funds and the founder of the Vanguard Group, one of the largest mutual funds anywhere with over $1 trillion in assets. Fortune magazine named him one of the 4 giants of the 20th century in the investment industry. Time magazine called him one of the world's 100 most powerful and influential people. Among his 6 books is this one, The Battle for the Soul of Capitalism, and more recently, The Little Book of Common Sense Investing. In the current issue of Daedalus, the Journal of the American Academy of Arts and Sciences, he has a blockbuster of an essay on democracy in corporate America. You'll find it on our website at pbs.org. I talked with John Bogel when he was in town earlier this week. Thanks for joining me.
My pleasure.
This story in the New York Times this week, what do you think when you read a story like that?
Well, first, it's a national disgrace, simply put. There's some things that must be entrusted to government and some things that must be entrusted to private enterprise. And what we see there, at least in my judgment, is that we've taken medical care, health care, and gone from making it a profession in which the patient is the object of the game, preserving the patient. First do no harm, as Hippocrates would say, or would have said, and turned that into a business. And so it's a bottom line. I've often said we're in a bottom line society, but we're measuring the wrong bottom line.
What does it say to you that the real owners of the nursing home, the private investors, have created this maze of smoke and mirrors that make it virtually impossible to find out who the owners really are?
Well, that's so typical of much that's going on in American finance, the way we structure these financial instruments, which are stock certificates or debt instruments. But it's the same thing of the removal of your friendly local neighborhood bank holding the mortgage and being able to work with you when you fall on hard times to some unnamed, often unknown financial institution who couldn't care less. But it's certainly, it's easy to say that greed is playing part. Greed has a role in a capitalistic society, but not the dominant role. And
what should be the dominant? What is the job of capitalism?
Well, ultimately, the job of capitalism is to serve the consumer, serve the citizenry. You're allowed to make a profit for that, but you've got to provide good products and services at fair prices. And that's the long term. That's what businesses do in the long term. The businesses that have endured in America have done that and done that successfully. But in the short term, there's all these financial machinations in which people can get very rich in a very short period of time by creating highly complex financial instruments, providing services that can be cut back easily, as in the hospital article, not measuring up to basically their duty. We all know that in professions it has been service to the client before service to self. That's what a profession is. That's what medicine was. That's what accountancy was. That's what attorneys used to be. That's what trusteeship used to be in, say, the mutual fund industry. But we've moved from that to a big capital accumulation, self-interest, creating wealth for the providers of these services, when the providers of these services are in fact subtracting value from society. So it doesn't work.
So the private equity nursing homes have added to their wealth, but they've subtracted from society the care for people who need it.
That is exactly correct. Not good.
The Wall Street Journal editorial page celebrates what it calls the animal spirits of business, and as if that's the heart of capitalism. What do you think about that?
Well, I like the animal spirits of business. I mean, Lord Keynes told us about animal spirits, and it comes out of a part of his work that says, you know, all the precise numbers in a prospectus mean nothing. What determines the future of a business is its animal spirits. You know, the desire for progress, the desire to create something new. That's all good, but it's gotten misshapen.
How so?
Misshapen.
How so?
Well, it's gotten misshapen because the financial side of the economy is dominating the productive side of the company.
What do you mean?
Economy. Well, let me say it very simply. The rewards of the growth in our economy comes from largely from corporations, or in very important measure from corporations that are providing goods and services at a fair price, innovating, bringing in new technology, providing a higher quality of life for our society, and they make money doing it. I mean, and the returns on business in the long run are 100% the dividends a corporation pays and the rate at which its earnings grow. That still exists, but it's been overwhelmed by a financial economy. The financial economy, which is the way you package all these ways of financing corporations, more and more complex, more and more expensive. The financial sector of our economy is the largest profit-making sector in America. Our financial service companies make more money than our energy companies, no mean profitable business in this day and age, plus our healthcare companies. They make almost twice as much as our technology companies, twice as much as our manufacturing companies. We become a financial economy which has overwhelmed the productive economy to the detriment of investors and the detriment ultimately of our society.
By the financial sector, you mean
banks, money managers, insurance companies, certainly annuity providers. They're all subtracting value from the economy. They have to subtract, to be clear on this now, I don't want to be overstated. To be clear on this, they have to subtract some value. But the question is...
What do you mean they subtract some value?
Well, in other words, you've got to pay somebody something to provide a service. It's just gotten totally out of hand. My estimate is that the financial sector takes $560 billion a year out of our society. $560
Where does
billion.
it go?
It goes into the pockets of hedge fund managers, mutual fund managers, bankers, insurance companies. Let me give you just one little example. If you didn't make $129 million last year, and I'm presuming that you didn't, you don't rank among the highest paid 25 hedge fund managers. 129 million doesn't get you into the upper echelon.
And on the way here this morning, I saw a story that now $1 billion will not get you in the Fortune 400. $1 billion.
Well, I haven't spent a lot of time thinking about that. I mean, you kind of asked the question, which I've asked in some of my work, what is enough?